Welcome to the FEG Insight Bridge. This is Greg Dowling, Head of Research and CIO at FEG. This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds to provide insight on how institutional investors can survive and even thrive in the world of markets and finance. Everywhere we look, we see real estate. Whether it's going to work in an office, visiting a doctor, shopping at a mall, staying in a hotel, or even that cell tower that links our smartphones, real estate is everywhere. But from an institutional investment perspective, how much do we really know about the space? Even before COVID, there was a lot of disruption going on below the surface. COVID just supercharged those changes. Today, we are hosting Jon Cheigh, the CIO and head of global real estate for Cohen Steers, one of the largest real estate managers in the world. He's going to walk us through trends, valuation, differences between public and private markets, and where the industry goes post-COVID. He's going to give us the REIT stuff. Jon, welcome to the FEG Insight Bridge. Would you mind taking just a few moments to introduce yourself and Cohen Steers?
My name is Jon Cheigh. I'm Chief Investment Officer of Cohen Steers. For those that don't know Cohen Steers, we are a focused boutique asset manager. Our two big areas of focus are listed real assets, particularly real estate, and our second big area is alternative income, specifically preferred securities.
We're excited to have you here. So before we take too big of a deep dive into real estate, let's level set a bit. Can you maybe define what a REIT is?
Yeah, sure. No, absolutely. I think whenever there's an acronym, it feels like there's a barrier to, what is that? What is a REIT? A REIT, the acronym just stands for Real Estate Investment Trust. Congress in 1960 created this REIT structure. And the idea was really to democratize access to institutional quality income producing real estate. That this shouldn't just be about institutions and it shouldn't just be about super wealthy individuals. And so a REIT is just a real estate owner operator. It's a company that owns a high quality real estate portfolio that generates income. They typically trade on an exchange like the New York Stock Exchange. Part of the deal with Congress 61 years ago was that REITs would pay out essentially at least 90% of their taxable net income to their shareholders so that shareholders could enjoy the benefits of institutional quality real estate just like institutions did. So over time, it's an industry that's grown and it's turned out to be a great investment area for individuals, institutions to get access to and exposure to institutional quality real estate and all the investment attributes that go.
So how big is the REIT universe? How many REITs are there?
These days, there's about 200 different REITs, and that's just here in the U.S. Globally, that number is close to 400. When you look just here in the U.S., these 200 or so companies, they own on the order of 2.5 trillion of real estate assets. That's a market cap of about 1.5, 1.6 trillion. So quite large. And of course, you might be thinking, well, why are there 200 of these REITs? What makes one different than the other? I mean, these 200 different REITs, they are invested in 13 different kinds of sectors or property types. This is not just office or malls or hotels. There's a wide range of different kinds of property types that I think we should talk more about. But also they may just be focused in different geographies. So of those 200, you might have your California apartment company. You might have your Washington, D.C. office company. So it's a big menu with a wide selection of choices for people like us, active managers, to say we love this one or we hate that one.
Some investors might be surprised that one of the better performing areas this year has been REITs. I mean, it's been a tremendous year for REITs. What's driven that?
So to put it into context, and I'll just talk as of the end of August. So U.S. REITs were up 29%. Great. Now, U.S. equities overall were up 22%. So we've certainly seen outperformance this year on the U.S. REIT side. I think to put this into context, last year, REITs were relative underperformers, meaning the equity market last year was also up 18%, actually same as this year, but REITs were down 5% last year. And so in a lot of recessions, actually, REITs can be defensive because they have contractual income, they pay dividends. But last year was unusual because we were socially distancing. We were all in our homes, in our apartments and things like that. So normally the dividends and cash flows of REITs tend to be defensive in recessions. But last year was an unusual recession with unusual impact. So I'd say real estate was hurt more than the average business last year, so it underperformed. And this year, while certainly we're talking here on video, so we're not 100% back to normal, certainly there's been some catch up as we've reopened. And you've seen that, malls are busier, hotels are starting to get busier, offices are starting to get busier. So I think you're seeing a rebound from social distancing, and that's playing out in stocks.
So not to rain on the parade, it's been a great year, but more recently, there's been a little bit of pullback just as rates have increased. So what is the rate sensitivity of REITs?
REITs have been around for 61 years, but it's really probably only been the last 30 or so years where you could say, let's observe how REITs behave at different points in time as it relates to interest rate cycles. I would say that when you look at how REITs respond when interest rates are up, usually in the short run, so let's just say that first month or two, you do see them pull back. That's kind of the first reflex. But what you find over time is that REITs then tend to rebound and put up actually very positive returns in rising interest rate environments. So that seems very counterintuitive because people might say, well, why should REITs actually do well when interest rates are rising? It all has to do with why interest rates are rising. If interest rates are rising because we're in a point in time where either hopefully real GDP is growing or inflation are growing. Better growth and some amount of inflation are positives for real estate. And those are much bigger positives than might be the negatives of higher interest rates. And so that's why there's a little bit of a short term, but then the kind of longer term fundamental case of good growth is better for real estate turns out to be the more persistent trend.
And we'll talk a little bit more about inflation a little bit later, but I wanted to talk about COVID. COVID has had such a major impact on so many industries, but boy, real estate, and especially things like retail and office, it's been amazing. So maybe we'll start with just on the retail side. What's going on there? Are we just going to be in an e-commerce world?
I think that COVID has had negative from a health standpoint, but from an economic and industry standpoint, there's been some positives and negatives for the economy as a whole. There are winners and losers. And I think real estate is just a reflection that there are some winners and losers. On the loser side of the ledger, I would say that retail early on was a loser, if you will. We had been, as a firm, quite negative on retail for really the last 4 or 5 years. In some perverse way, there's actually some positives. And again, this is coming from someone that's not that positive on retail going into this. There have been some counterintuitive positives that have emerged from this. So let's just take your local shopping center, okay? Well, shopping centers tend to be suburban, not urban. And we expect that people like me, maybe people like you, and maybe people like your viewers and listeners may go to more of a hybrid live work kind of experience. And so that means, it's a bit of a negative for my Manhattan sandwich place. The REIT market doesn't have a lot of exposure, frankly, to urban retail. It has a lot more exposure to the suburban shopping center. And so the bagel store, the sandwich place, the workout place, they're all going to see more retail dollars, frankly, decentralized from most metropolitan areas. So I think for suburban shopping centers, oddly, I think there are some positives. I also think on the mall side, look, we've always been in this trend where there are going to be some that are going to die over time. I'd say there's been an acceleration of that. But for the so-called survivors, we think they'll end up stronger. And, our government has pumped a lot of fiscal stimulus into the system. So government sends money to people. People go to the store, and essentially that sends money to retailers. So in some odd way, for the retailers that have made it through, which unfortunately it's not the mom and pop, it tended to be more the national retailers, their balance sheets are stronger today, meaning money went from the government, consumers, to national retailers. So the balance sheets of retailers is much stronger today than it was 2 years ago. And so that's been a big positive for malls and shopping centers. So it's a little counterintuitive, actually.
It seems like the more of the lifestyle centers have done a lot better than just the kind of old, Class C type of malls. We're more likely to go to the Starbucks or the outdoor eating area that also has retail around that. So that's certainly feels like that's changed a little bit, and maybe you can comment. But I also wanted to ask you a question too, is the best way to play retail to invest in logistics and e-commerce, so warehouses, and is that a play on retail?
I think it's part of it. I think it's going to be a different play. I think the e-commerce logistics, that's a play on one, consumption, and two, just the move to e-commerce, which is going to continue to be the case. And so, I think there's a very strong story for there. That being said, valuations for things in logistics, it's not just the REIT market. This is in the private market. Things have run there. Doesn't mean it's a bubble or anything like that. It just means they went from being really cheap to, they're more on the expensive side to other things. Again, 4 or 5 years ago, we didn't like retail when people thought retail was fine. Now we're at the point where the average person thinks retail is bad. And for us as an investor who's looking for value, we see value there. So it doesn't mean it's as good as logistics, but it's got the valuation relative to kind of what those fundamentals look like. But, Greg, to your point on those lifestyle centers, we're social beings. There's a lot of positives towards, work from home and things like that. We know that there's going to be, I've been saying to people, like, if you're ever going to own a restaurant, these are the 2 years, besides the labor side, right? Besides the labor side. But as it relates to just the amount of pent-up socialization that wants to happen, your neighborhood shopping center is going to be busy as it relates to restaurants. And so I think that even in a hybrid work home environment, like when I'm working from home, when you're working from home, you're going to want to get out, during the course of that day. You're going to want to get out some. And so I think that that's business that a suburban shopping center didn't have 3 years ago, because it might have done 4 hours of business during the week and 12 hours on the weekends. Basically, there's just more days in a week that are going to be busier.
I love that point you made. Valuations matter. Price matters. Yes, logistics are a growing part of everything, retail especially, but everybody's figured that out. So if you're late to the game, it's expensive, where everybody hates retail. So if you pick the right retail exposures, that might actually be a good thing. So I think that's a great point. You can't just do these things in isolation. I wanted to maybe switch gears a little bit, because I think of retail. The other thing I think about is office. I'm doing this from my office, and we're maybe about a third in, just recently in New York, and it's starting to come back. I think everybody's adopting some form of a hybrid work schedule, whether that's 3 days in the office or 2 days or whatever it is for that particular business. Office has really been transformed by COVID, but at the same time, everybody signs long-term leases. So is all the change priced in to office right now? So what's going on with office?
We were not that positive on office going into COVID. In contrast to us becoming more positive on retail, I'd say in office as a whole, because again, this is real estate, right? It's not like there's one office building you can invest in or one shopping center you can invest in. There's tens or hundreds of thousands of opportunities. So you just need to find 5 or 10 that are different than kind of broad brush. But I think the broad brush is we weren't that positive going into COVID. I'd say that as a general rule, you could see this work from home trend being anywhere between 5 or 10% negative over time to the demand picture. And it's going to take time. Like you were saying, it doesn't just happen overnight. People don't just, rip up their leases as much as they might like to. They don't just rip up their contracts, but they do deal with it over time. So, instead of companies growing their office space 10 or 20% at the end of a 5 or 10-year lease, they might stay the same, or they might shrink 20%. So, we think it's probably like a 5 or 10% negative over time. For those that want to go to the extreme to say, well, how is that possible if you work from home? If only 60% of people show up on a given day, why can't you give up 40% of your space? As you know, no one might show up on a Friday, but even though 60% on average might show up in the course of a week, it might be 90% on Tuesday, 90% on Thursday. So unless you really want to go down that path of trying to smooth out your office utilization over the course of the week, which I don't see happening, you're not really saving 40% of your office space. So I think the bigger hit comes if you think some portion of your employees, so 10% of FEG employees all of a sudden become fully remote, or 10% of Cohen Steers employees become fully remote. That's when I think it changes. And so a place like Cohen Steers, we're not going 100% of our employees can't be fully remote. Are there 5, 10, 15% of probably many companies that could go fully remote? I think that's possible depending upon your business. And so that's where maybe a bank's employees, instead of going to New Jersey from New York, they're going, some people are in Tampa, some people are in Dallas, some people are in Salt Lake. So I think it's those fully remote that may grow and have a bigger impact. So 5 or 10%. So it's a negative.
That's a great point, though. I mean, we're seeing a lot of change going on. And when we think of office, I think most people in their head visualize Manhattan office. How much is it different by geography, also by property type? Does Dallas medical office, is that a lot better than owning Manhattan Class A space?
They're hugely different from a geographical standpoint. Not exactly a zero-sum game, but it is. There's some out-migration and in-migration that's happening. Obviously, a place like Phoenix has boomed, Vegas booming, Austin booming. And then you have places like New York and Boston where not booming. So, I think Americans aren't leaving the U.S. They're just finding different places to live and enjoy their lives. And so I think the geographical side, winners and losers, I think from a sector standpoint, there are some malls that will go away. That's negative. But there are some logistics facilities off the highway that don't look very interesting or trophy-like to you, but they're doing really well. So I think that we see this in our own business where the move towards kind of passive management has grown and grown and grown. But certainly in the last 12 months, I don't know if this is the case outside of kind of real assets. And we're definitely seeing people say, you know what, there's a lot of disruption. This is not just everything's going up. And if it's not an everything's going up kind of world, I need to identify winners and losers, right? Because a lot of times the losers are big parts of indices because they're the ones that had big market share of whatever they were doing and they're shrinking. So yeah, New York was the biggest city. I mean, probably still be the biggest city for a while, but it may underperform for a while. So if you're just exposed to the big cities, you may get hurt by that.
Absolutely. Speaking of everything going up, maybe last COVID related question. I'm blown away by how much hotels have gone up. And yeah, I guess we're traveling again for leisure, but business travel is still pretty flat on its back. How are hotels priced so richly?
Let's put this into context. So the S&P 500 was up 18% last year and 18% this year. So the overall equity market is up a lot. Okay. I can't do the math, but 18 and 18 seems like it's up a lot. 35%, 36%. I'm sure there's some compounding in there. So the overall market's up a lot. I would say the hotel real estate companies, depending upon the company, they might be down a little bit versus where they were pre-COVID, or they might be up a little bit, depending upon their footprint. So I think that for the leisure side of the business, it's kind of like that restaurant side we were talking about, like huge pent-up demand. I also think that with work from home or work from anywhere, people are going to have a lot more flexibility. Like, I don't think it's all that flexibility is going to end up in the hotel market, because Airbnb, VRBO, there's other places besides your hotel REIT. But I do think that instead of this being people work in New York for 48 weeks a year, and then they are in a particular company, Marriott Hotel, for 4 weeks a year, it could look really different. It really could look different. People could be traveling and working 12 weeks out of the year, not 4. Now, maybe all 12, like I said, it could be 6 are in VRBO and 6. So I think the leisure side is going to grow, definitely going to grow. I think the business side, I actually think there'll be pent-up corporate demand. Hey, I haven't seen my clients in a while. I better go out and see them. But once we get through that, we think you'll probably be down to 10 or 15%, potentially more. That's why, again, like we've talked about, there's winners and losers, and we think you need to be targeted. And if you're a big convention center hotel in New York, Chicago, and San Francisco, you're kind of more on the losing side. If you're a resort hotel, the next 5 years look brighter than you would have thought they were going to look 2 years ago. So.
Yeah, no, that's a great point. And we've kind of hit the poster childs of COVID. I think of retail and maybe a little bit of restaurants, but then also office and hotels. And when we were talking a little bit pre-call, I love a line that you use, like, hey, this isn't your dad's REIT index or REIT universe anymore. These are pretty small. So maybe talk to us a little bit about like that vis-a-vis some of those other things that maybe you alluded to earlier in the call that are pretty interesting and really growing.
That's the big thing. I've been involved in real estate for 25 years or so. And the really cool things you wanted to be involved with back then were big, shiny office buildings, hotels, and malls. Those were the trophies, if you will, the things you wanted to put on your annual work. When you look at the REIT sector now, and, the biggest sector in the REIT market today are cell towers. They're 16% of the U.S. REIT market. After that are warehouses, 11%. And after that are data centers. While these aren't things that you would proudly put a picture of your data center or cell tower in your headquarters walls, only 36% towers, data centers, and logistics. 36% of the REIT index are things that you would associate with essentially some kind of like e-commerce, cloud, supply chain.
The crazy thing is, outside of a real estate investor, if you just ask most investors, broad investors, allocators, hey, what's the biggest allocation in the REIT index? I would bet the majority of people would not say cell towers. I think that's a surprise to most people.
For sure. Because look, it's no different than if you look at the equity index today versus 20 years ago. 10 years ago, at some point, a bank was the biggest part of the U.S. equity index. And then at some point, it was GE. At some point, it was ExxonMobil. So in the same way that our equity indices, they change. And frankly, the indices always reflect the future, right? They don't reflect the economy of today. They reflect growth prospects. So it's changed a lot. I was just looking at our U.S. real estate portfolio. 1.5% of our U.S. real estate portfolio is invested in one office company. It's not that it's an irrelevant sector, pretty small. Retail is only 8% of a benchmark. So there's many things like apartments and healthcare and data, all these things that are much bigger than retail. Things have certainly changed a lot. The real estate we need in the future, not the real estate we used to need.
Well, it's even bigger than that, right? I think of like manufactured housing and self-storage. Talk to us about some of the other areas. They may not be bigger allocations, but that have been put into REIT structures.
Yeah, so I said earlier that when you look at the U.S. REIT market, that there's 13 different sectors. And that's great because as active managers, it provides us options. So there's different kinds of residential. There's your regular multifamily apartment. Over time, there's single family for rent. There are things like manufactured housing, which doesn't seem like the most interesting business in the world, but it's been a great business. There's things like self-storage. There's things like healthcare. And within healthcare, there's medical office buildings. There's senior housing. There's life science and biotech buildings. And each of those is a little bit different driver of what makes them well or not. Within retail, there's malls and shopping centers. Of course, there's different kinds of office. There's student housing or university housing. There's data centers, industrial. Over time, there's actually gaming facilities. Blackstone Community Fund actually just Blackstone REIT, the Cosmopolitan, big casino in Las Vegas. And there's a wide variety of different kinds of investment options.
If it's physical and there's a lot of it, it's probably been securitized or put into a structure. Really amazing how you can invest in all of these different areas. And I think it's fascinating. But when you talked about valuations earlier, maybe real quick, what are the best ways to value real estate versus everybody knows stocks and maybe you'll look at price to earnings? What are the right metrics for public real estate?
There's really two primary ways that we try to figure out relative value. One is these are real estate companies. So we're trying to value the real estate. And so we come up with each company, our view of essentially what is its net asset value. Of course, there are appraisers, but sometimes, no offense, that could be a little backwards looking. We're going to express our own view of what do we think the sum of the parts real estate portfolio, what's it worth? So 4 or 5 years ago, maybe we thought, wow, these malls, they're really overvalued. Not that an appraiser would tell us that, but we just thought this is where the world's going. Here's our view of where we're going to end up. So one is, what is it worth versus just real estate value? The second is more of a going concern valuation. So we're doing a discounted cash flow. The distinction here is first measure is to just say, what's the real estate worth? But these are companies. Some of them are really good companies and they should be worth more than the sum of the parts. And some of them aren't that great. When you're not that great, maybe they should be worth less than the sum of their parts. That's why it's important in thinking about REITs that it's not just some passive portfolio you're buying. Some of them are great companies that always trade at a premium to the underlying real estate. That's because they make smart decisions. I mean, they're like great portfolio managers. They add alpha. Anyway, so we look at them in both measures. Every now and then we find stocks that look great on both measures.
So when we look at public valuations, how does that compare to private valuations? There's been a lot of public to private. What does that say about the different ecosystems and how they're valuing the markets?
That's an interesting point because, when you look at other parts of the equity market, you don't normally compare it to the private market necessarily. There's a couple of instances where you see that, but I think you do that in the real estate market because the reality is while the REIT market is a big market, the private market is a bigger market. And so if the REIT market trades at too big of a discount to the private market, it's an arbitrage opportunity. And Like I said, I've been doing REITs for 20 years, probably seen a Blackstone or a KKR or someone, take private a REIT 30, 40, 50 times in my career. Just in the last 6 months or so, you've seen Blackstone take private data center company for a 30% kind of premium. We actually saw PIMCO take private an office company about a month or so ago for 15, 20% premium. So I think it's certainly depends on the company. If you're a really good company and you're doing well, I don't think they're necessarily going to be taken private. Maybe they don't trade that cheaply in the public market, but there is some downside protection, if you will, because if a company isn't getting it done, they could always be an M&A target for activists. And we see activists in the space, definitely, or just some kind of a friendly M&A. So I definitely think it's a reflection that there's a lot of capital in the private markets, and there's a lot of high quality companies trading at good valuation in the public market. And I don't want to say smart money, but certainly intelligent enough money is seeming to be entering the public space.
If you think about it from just a sort of a purely philosophical standpoint, there should be a premium for liquidity, right? And it seems like the private market is a lot more expensive than the public market in real estate, and probably in a lot of other areas too outside of real estate.
In theory, there should be an illiquidity premium to be in private. And I think the data says you do see that in things like private equity and venture capital. I don't study that, but that's the research I've read. You don't see that in real estate, which sometimes surprises people because they think, oh, well, I'm tying my money up. Certainly, I must get that. But, you don't see that. And so, again, I think that's a generalization. I'm sure that there's a private fund and there's a private opportunity where you do earn an illiquidity premium. But if one were to just compare over the last 10, 20 years, you went to a private fund versus if you went to a REIT, which one you would have done better on. Under most time periods, you would have done better investing in a REIT. That's why, these things go in phases. But I said earlier, we're talking to more people about going active versus passive. We're talking to more people look at their core real estate portfolio and are just wondering, hey, should I be more in REITs than in core real estate? Sometimes there's a new CIO or something, who has a different view. And I think that it's healthy to re-examine some of those prior assumptions.
A couple of other questions, and this is kind of the current environment. We talked a little bit about rates, and so we kind of hit that, and we talked a little bit about inflation, and there's also a lot of other things going on from a kind of a political and policy standpoint. Does anything like the infrastructure bill or any of the tax increases, does any of that impact real estate?
I would say there's not big direct impacts. Like any fiscal package that requires increased corporate taxes, generally REITs aren't going to be affected by that because REITs don't pay corporate income tax. Now, if you go back to, I guess, 2017, when we lowered corporate taxes, that was a positive for the equity market, but it didn't help REITs. To the extent that there's a partial reversal of that, you could see, you've seen estimates, people say, oh, the S&P 500 earnings, they're hurt 5%, 8%, 10%. You won't see similar kinds of research notes. So it's not that it's a positive for REITs, it's just that they avoid a negative of higher taxes. I'd say on the infrastructure side, look, to the extent the infrastructure is done in a way which we all hope that enhances GDP in the short term, but also enhances productivity and GDP in the long term. Again, better growth is good for real estate, but that's more indirect. There's some provisions on kind of rural broadband access. I think that'll be a positive for 50 billion, 60 billion, something like that. That'll be a positive for tower REITs because just more money going into this idea that we need to connect everybody or more of us, because it's a necessity in today's economy. And so I think that that'll be a positive for tower REITs, but it's not a 20% game changer. It's a modest positive.
As the REIT industry has changed and it's not your dad's REIT index, this is not your dad's infrastructure bill, right? There's a pretty small component that's in kind of roads and bridges. There's a bigger that is more on digital infrastructure and 5G and connecting rural communities. And that's translates pretty well for towers. So like people probably don't even get that. They think, oh, roads and bridges, and that maybe is that good for other physical real estate? And I don't know, maybe not, but it definitely helps towers.
For sure.
So we've talked US, right? We're home country bias. We're in the US. We mostly invest in the US, but REITs are not just a US construct or idea, right? So talk to us a little bit about what the REIT universe looks like ex-US.
I said earlier that the U.S. REIT market is 1.6 trillion in market cap, has about 200 companies. Outside the U.S., about 1.4 trillion, 1.3 trillion. So it's big outside the U.S. and it's almost the same amount of companies. And this is spread across about 25 different developed markets. So this is Australia, Japan, Singapore, Hong Kong, France, UK, Germany, Canada, most places that you would think of. In the same way that we have a menu here in the U.S. of what's good for Austin, maybe bad for New York, there are things that happen like that. So, an example, a Brexit, is it good for someone, bad for someone? Things that are going on in Hong Kong, if, companies may move over time. It's like Singapore, there are some relative winners and losers to these things. So it's a big market with a lot of different options. I would say that the fundamental and investment recovery has been slower outside the U.S. I mean, the reality is the U.S., earlier on, we did a better job kind of getting the economy going. Some of them, did the most fiscal stimulus. I think in other parts of the globe, as vaccination rates, move up, as stimulus moves up, you're seeing that the U.S. is starting to slow a little bit economically, again, from a really high level, and other places are starting to pick back up. At the margin, we probably favor the international market a little bit more, U.S., because it's a bit of a catch-up trade, if you will. There's a lot of opportunities there. Some of the retail and office dynamics like that, I'd say all these things, this is an unusual thing. Normally, real estate's a local business, but some of these pandemic trends, they're global. Obviously, social distancing was a global thing. E-commerce is a global thing. Work from home is a global thing. But the magnitudes are a little bit different. Let's just take the office sector in a place like Singapore. There's a little bit more of a FaceTime culture. Tokyo as well, a little bit more. So work from anywhere is not really going to happen. And being in the office 5 days a week is more likely to happen. And the other thing is where people live, they live in a 3-bedroom, 800 square foot apartment. They don't have a McMansion or anything like that with dedicated home office or something like that. So there is a greater desire on the part of the company for people to come to the office, and there's a greater desire on the part of the individual. Well, we don't like office as a general rule. I said earlier that you just got to find the opportunity. We like Singapore office because we do think it's benefiting from companies moving from Hong Kong to Singapore over time, and it benefits from not having some of these negatives.
That's interesting. I've been to Singapore. I've been to Hong Kong. That's spot on. That's pretty interesting. You said catch-up trade. I guess I don't even know what the difference in performance is. So what is the difference in international REITs versus U.S. REITs right now?
I'm going to give you the approximate numbers. Let's just say since the start of 2020, U.S. REITs might be up, let's just say 20%. Okay, they went down, they came back. Again, the S&P might be up 40. The U.S. REITs might be up 20, Europe might be up 8, and Asia might be down 5. So there's pretty decent spread. Look, so I think some is warranted, but our job is to figure out the difference between over-discounted versus what is warranted.
Last question, and really kind of pulling on a string. Something you mentioned earlier about you were talking to new CIOs and public versus private. Talk to us a little bit about what you see as you talk to investors. How big is their real estate portfolio and what's the role that REITs play in it?
Real estate in general, whether it's public or private, I think investors are looking for this magical combination of income, total return, diversification versus stocks, bonds, and other things. And related to that, kind of that inflation sensitivity. Okay. So that's just real estate generally, whether you go private or through the REIT market. I mean, the underlying is still, there's real estate there, right? I would say that for most institutions or individuals, you could see the range be anywhere 5 to 15%. Everyone's got different reasons to be one versus the other, but that's probably the general range. In terms of whether they choose to go private or they choose to go the REIT side, I think everyone's a little bit different. Obviously, if you need liquidity or want liquidity, you got to go really on the REIT side. Sometimes people prefer that there's less volatility, at least reported volatility on the private side. I think at this point, most people know it's like an apple and an orange to calculate the volatility of something listed versus stock. But even though people know that it's not terrible, they still like the fact that it doesn't move or it doesn't move much. And so that's a consideration. People usually do 5 to 15%. On the REIT side, you also see people, again, depending upon the group or institution, if they only have 20 million, 40 million, 50 million, to work as an institution. It's sometimes hard to do that in private because, you want to be diversified. And also you don't want to have to worry about, did I pick the right manager or anything like that? Whether it's us or someone else, we might own 40 US REIT stocks. And each one of those is a company. And each one of those companies might own 100 to 2,000 properties. There is a lot of diversification. And each one of those companies, it could be an S&P 500 company. They're very professionally managed, very efficiently run. So for some, they might say, you know what, I want exposure. REITs have done better than private over a long time. This is an easy way for me to get exposure. I can outperform, and I don't have to worry about some of the technical issues with investing in private. So anyway, so we've certainly seen that grow.
Yeah, that's interesting. Thanks for sharing that. We always talk about stocks and bonds. Real estate's such a big part of the market. We don't spend enough time talking about the trends and understanding it. So we really appreciate your time today. And thanks for giving us the REIT stuff.
Thanks, Greg. It's great to be here.
If you are interested in more information on the topic, please go to our website where we will have a list of relevant FEG publications. And don't forget to subscribe to our communications at www.feg.com/subscribe so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views or opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of FEG.